Live. It's my pleasure to have you with me tonight. I can see a few of us are already in the chat. Chef Circle, the first comment that I read, and this is a great one, I think you'll like this, is Telstra is a cat with fleas. Now, if my co-host on the Australian Investors podcast could hear you say that, he'd probably be, well, I won't say turning over in his grave because he's not dead, but he's been a very strong proponent for Telstra the past 12 months, which is why I put it in the discussion. So yeah, I can see a few of you have already vote on which of these is your favorite. And there's a poll in the live chat and it says ResMed, Cochlear, Telstra, and none of them. And I can see 32% say Cochlear is their favorite. So I was actually going to start this evening with a question for you because normally everyone has questions for me, and I thought I would maybe return to sender really quickly. And that is, I want you to divulge, I want you to tell me what is the best investment, whether it's by percentage points, like the percent gain, or by dollar value that you've ever made. And what is it? And if you could share that in the chat, if you're willing, that would be wonderful. And of course, we all have losers. And of course, we're not giving advice when we put these things in the chat. I just wanted to ask you what it is, because we so often get asked that in the financial news. We get asked about, well, what's been your best investment? What's been your worst investment? But I'm curious, what's yours? How's the painting going? Says Go Hard Productions. Well, you can tell by the look of my hand. It's actually it's been going. There's been more on the wall, I swear, than on my hands. But who knew that you needed to take oil-based paint off your hands pretty quickly after using it? So I probably could have picked that up. But yeah, I'm actually going to dinner after this, and I thought that's not going to be a great look when my whole hand is white. So Daniel, you've said equity in the principal place of residence. So equity, that's great. Daniel, is that just off one property that you've got that equity accumulating? Because I'd say for a lot of people that is, and a lot of people just sit on the equity in their one home and they just hold it forever. Jeremy, you've said IVV, the ETF, which is the S&P 500, 6 months of ownership. Solpat's 18 months. Solpat's 18% growth in 18 months. It's not bad. Spotman, you've bought PME. Pro Medicus, that is not my best investment, but definitely probably the one that I get the most credit for, at least from our members. But anyway, I've got to get on to the thing that you guys all love, which is my disclaimer. So before I go on any further, I'll just bring this up right here. This week's joke comes courtesy of Mel. And when I asked her, where'd you get the joke from? She said, I Googled bad dad jokes. So the joke is this: what's the most detail-oriented ocean? The answer is the Pacific. And that's because most people would say specific. So that's the one. Where are Michael Jackson gloves? Says Chef Circle. Yes. LTR says JJ. And Daniel, you did respond. Thank you. Yes, one property, considering my options on how to responsibly use it. Yeah, that's a really good point. 2 out of 10, Chef Circle. I'll take a 2 out of 10. I'll let Mel know that was the outcome of tonight's joke. And I will take no credit and no responsibility then for tonight's joke. Just even that up a bit. There we go. Pastor Salt, you've said PLS up 122%. Only bought it just over a year ago. So wow. Palav, you've said Wise Tech 850%. Wow. So wow. Rob's given me a very strong 8 out of 10, which I'll take. Okay, so information warning. This is the warning that we all know of. It's a great warning. Much like the OHS that I didn't really think about in the bottom corner here. If you can see that on the screen, we were recording. This is Drew, my co-host on the Investors podcast, and we were recording at the ASA event. And actually, Rob, at the time of this recording, is probably just on the other side of this light here, not like in a different realm, but actually on the other side of the room. Rob was standing on the other side of the wall there when this photo was taken, I believe. So there you go. I was a little off to the side. There you go, Rob. Okay. So so I was recording with Drew, and I didn't realize that all of our microphones on the ground, and we have about 20 tons of copper sitting down there with all of the tripping hazards. So anyway, back onto my disclaimer. As you know, Selfwealth Live contains general financial information only. That means the information does not take into account your needs, goals, or objectives. So you should not act on any of the information or any of the questions, comments, or anything that you see or hear tonight until you have spoken to a licensed and trusted financial planner. There are about 13,000 or so of those left in Australia. Owen is the founder and director of the Rask Group Proprietary Limited. There's an ACN there, which is a corporate authorised representative number 1280930 of Waddle Partners AFSL 383169. Please refer to the Rask Group's Financial Services Guide for more information on what I can and can't say. The views expressed in the live streams are solely those of myself and or the guests. We don't have any guests tonight, but we will be having some soon, and do not necessarily reflect the views or opinions of Selfwealth. Whew. So that's it. Robert King, hello. I like how you spelled everyone as in every and then one, the number one. That's great. Tooney, you've got my best investment was Prime Media. Bought it as a cigar butt about a month before the 7 takeover. Made like 70% in a month. Wow. 70%. Well, let's annualize that, and it's pretty great. If he panned to me, it'd be the best disclaimer ever, Rob says. Yes, great. That's a good question, Jeremy. He said, did the Selfwealth Live win the is this the Financial Education Award? Yeah, that'd be great to know. I don't think we know until the 1st of June. Okay, so tonight we're talking about tech stocks. And I'll get to why we're talking about tech stocks in just a moment. But many of you will know that we talk a lot about a core and a satellite approach. And I'll see if I've got that in my old slides here. I've named them slide old. I do like using Canva over Google, but Google is definitely more functional for these presentations, especially when you've got 300 slides and you've done that a few times around. But you will remember, this is just for anyone that may be tuning in. We've had a few new subscribers join Selfwealth Live recently, but you will know that we talk about the core and the satellite approach, and this is really just to kind of like cover my own butt a bit. So when we talk about the core and the satellite approach, and we have this core strong portfolio, maybe ETFs, like blue chip shares, managed funds, and even some people have investment property, they consider that as part of their core. What we're talking about tonight is probably more along the satellite, so the higher risk investments. These are the investments. Where are my slides? Here we go. These are the investments that you may take what we call an active position on. So you have a very strong view that one company might outperform another. And I put a lot of my tech investments in that satellite. And the reason that I do that is, even though I think these are the best types of companies in the world and the types of companies that I want to own, what I really want you to remember is that even the future of some of the biggest and best companies are uncertain, because if you go back 50 or 100 years, the biggest companies then are not the biggest companies now. And that is illustrated here. This is just a screenshot, and I'll get this Apple thing out of the way and this botched Microsoft thing. I'll bring that to the front. So you can see here, like, why are we talking about tech stocks? I would say like a once in a generation shift that we've seen towards these companies. And you never know, we could be at the top of that right now, right? So when we look inside the VGS ETF, one of the biggest ETFs in Australia, it covers like global shares. You get 1,500 of the world's biggest shares inside this ETF. And inside the ETF, you get Apple, Microsoft, Amazon, Nvidia, Google or Alphabet. You get Facebook, Exxon, United Health, and Tesla. So of that list, only 2 of them aren't really like deep technology companies. The rest are just complete technology companies. And if you go back 100 years, they would have been railroads in this ETF, if this ETF existed back then. So Chef Circle, you just pointed out, that even the FANG ETF, I noticed one of my peers, Marcus Padley, who I caught up with recently, is talking about the FANG ETF as a great way to get exposure to these US tech stocks and some Chinese, because it's got about 10 positions in it. This ETF from GlobalX here. And you can see it's been on a tear. So basically, since the beginning of the year, you could have bought it at the beginning of the year and you'd be up, like 60% since the beginning of the year, 55, here we go to be exact. So definitely when people thought technology companies were down and out, that's proven not to be the case so far. This ETF, I sometimes debate with people, but this ETF I would also consider as part of the satellite because it is so concentrated. It's got 10 positions. Now, So we know that like technology has been around for like 30 years, in particular, these types of companies. Like all of these companies, I think Microsoft was 84, 85. Amazon was a bit later. Apple was a little about the same time as Microsoft in terms of its founding. Google, a lot more recent. Facebook, a lot more recent. Tesla, when Elon Musk bought into them, I think was 2007, 2008. So like a lot of these businesses are quite new and they've already rallied to be trillion-dollar companies. But that may not always be the case. Now, I'm going to quickly recap on something before we get to the list. So, you know that there's this concept of tech in investing of these companies that have a wide moat. So, this would be like the ring of water, like this blue patch here that goes around a castle, the castle representing the business. So, the moat protects the castle, i.e., the competitive advantage or the defensive features of a business or the industry protect it from an army, from competition. And so what we're trying to find are businesses where the moat can't be easily crossed, businesses that have defensible positions. Now, some of you may have seen the next two charts, but I'll be quick with them. And I'll try and zoom in a bit here, maybe, just so we can, and I'll get rid of that and get rid of this annoying Apple and Microsoft logo. So in practice, what does it actually mean? Well, when you have a company that has a moat, basically what you're getting is you're getting a company that captures more of the value of that industry or that trend or whatever it is that it's going for. You get a business that captures more of that than a similar company might do. And so you can see it's illustrated here. And this concept comes from Morningstar primarily, who took it, I believe, kind of from the teachings of Warren Buffett. And you can see here that a company that doesn't really have a moat won't capture that much value because it can't really increase prices and it can't really stay in the market for a very long time. So a good example of this would be like a local cafe. Most cafes don't have a competitive advantage because another cafe can just open up next door and probably undercut them and take a bit of their pie, so to speak. Then you have companies that have some moat. So these are businesses that may have like a little bit of pricing power. So maybe there's like a really special cafe that's like, in the city. It's where everyone wants to go. It's got a really good barista and they serve really good food and you won't get it anywhere else. Maybe it has a little bit of pricing power, but it's not going to stay there forever. And so that's a business that could capture more value by putting up prices and maybe even stay in business longer. But chances are that business is still going to go out of business in the next 5 to 10 years. Finally, we have these businesses that are called wide moat businesses. So these would be businesses that can sustain high returns for 10, 20, or 30, 40 years, maybe even more. And these businesses are able to increase prices and keep customers. That's the key thing here. A lot of people just think, oh, they've just got big profit margins or their revenues go up. Great example, Chef Circle. Fantastic example, Bunnings. So I've been to Bunnings twice, 3 times in the last 24 hours. And I don't go to Bunnings and negotiate with them. I don't go up to the cash register and say, hey, how much will you do it for cash? Well, Mitre 10 has it for, $2.50 cheaper. I go up, I'm the price taker. I take whatever's there. I pay for it. Now, they stock the best brands. They have the lowest costs. Pardon for the lateness, says Benny. No, you're not late at all, mate. We're here typically, a little bit after hours. But I'll go to Bunnings regardless. It's kind of like one of those businesses that I'll go to, and they could probably still increase prices again and again and again. Not too much, but they could keep increasing it and I would still go there. Now, you could probably say the same about supermarkets and those types of things, but supermarkets they don't really have the same competitive dynamics as like a Bunnings because there's only one Bunnings. Woolworths is massive in supermarkets, but it's not the same thing because it sells the same products, whereas you can't get the same products at a different hardware store. So these types of wide moat businesses are very hard to find, but when you find one, you don't want to give it up. Owen West, you've said, welcome. Well, first time. I love Owen's content and his name. Well, Owen, that's a great name. I will give you that, mate. So welcome to the program. I hope you stick around for a while. I hope we can keep you entertained and maybe bring you some insights to match. So then the question is, okay, so we know that some businesses are built better than others. Morningstar, who employ, I think, hundreds of analysts around the world, did an analysis quite a few years ago now, and it caught my attention. what they tried to do, because they bucket companies into these three categories. They say, are you a wide moat company? Are you a narrow moat? Or like a business that's a little bit of competitive advantage? And do you have no moat? So for example, Technology One, which is one of the businesses that we're talking about tonight, you can see some research here from on Technology One from one of the analysts. They give the company a moat rating. They also give it a valuation rating. So don't necessarily take a note of the star. Just think that they have a moat rating, and they assign every company that they cover a rating, whether it's no moat, a narrow moat, or a wide moat, which is the best. So in this chart here, you can see that when they went and looked around the world, they tried to identify which parts of the market have typically the best types of companies. And some of you may have seen this before. It comes from our valuation program that we teach. But what it actually shows you is that some of the industries tend to have more of these really impressive companies. So a good one is like a consumer defensive company. So this is where you may have a business like Bunnings. You may have in the United States like Home Depot, Costco, these types of businesses. Now, if you look at healthcare, that's another industry with really promising and favorable industry dynamics. So in the question that's at the top of the chat here tonight, we can see that most of you chose Cochlear and ResMed over Telstra, which, to be honest, I would choose them too. I'd probably choose Cochlear, although ResMed is a seriously impressive business. And so they fall into this healthcare bucket right here. If we go across to real estate, a lot of you may have read in the news, indeed I've been reading in the news, how many builders are going bankrupt. Now, I explained the reason why this happens, but recently on an interview. But most of the building companies in Australia operate on profit margins of around about 3 to 5%. So if their costs go up 3 to 5%, they're losing money. And we know that the costs of things like steel, their debt because of interest rates, they've all gone up like 30%. So that's no wonder that many of the building companies are going bankrupt. And yet is another reason why you should be skeptical before buying off the plan. So we know this, some industries are better than others. That's a very generalized statement, by the way. Some builders are fantastic, as we know. But you can see across different industries, different things shake out in different ways. But one of the things that kind of really dawned on me early on is that technology, which is the second last one, industrials, healthcare, and consumer defensive is where I should be focusing most of my time. So just to recap, the defensive consumer staples type companies, like your big supermarkets that are really competitive, not so much energy, and I'll come back to that in a minute. Consumer defensive, healthcare, and technology, and you could say industrials as well, which is this one here, which is kind of like a broad sweeping statement. Now I'll get to that in just a sec. So most of you should have seen in the chat, and I'll see if I can share this from here. I can see there's about 30 of us in here so far. So this should be in the chat now. Most of you can see, and if you click on that link, it may take you away from the video, just so you know. But most of you can see a spreadsheet in front of you. Now, if you keep this for yourself, it's really easy. All you've got to do is click File, Download, and then download as Microsoft Excel. I think you can also add it to your own, make a copy or import to your own Drive account if you have a Google Drive account, Google Drive being free, right? Now, you can see here, right-click, open a new tab. Good one. That's it, Paul. Thank you. Let's have a sip of my drink. You can see here that across the top, we've obviously got our header row, and we've got the different technology companies going down the ASX here. I've ranked them, I think this is ranked, by return on invested capital, which I'll get to in a minute. And you can see I've included a few other basic things in this chart. Jason, you said had a Seven West Media since it was unloved at around 10 cents. You're answering the question from earlier on about the companies. So you've had this since 10 cents. So you're on a 4-bagger at the moment. Wow. And you've held it for a little while. That's great. Stevie, you said, I only know Atlassian and Xero. Well, I'll introduce you to a few more names tonight. So just quickly, I want to just explain a few things. When I pulled up all of this data, Is it data or data? I think that's a good question. Maybe we should ask it. Is it data or data? If you can explain your view in the chat, I'd be forever grateful. Sometimes I say data just to annoy people, and it does pick up a few things. I just like Palmer versus Palmy. Obviously, being a Victorian, I believe in Palmer. But if you're from a different state, you might say Palmy and say I'm backwards, which is fair enough. But anyway, so you can see here data. We're Australian. Yeah, fair enough. So you can see here in the sector column, I've actually included healthcare and I've included communication services. So that's this one here. And I'll zoom in a bit. The reason why I included the other two is please don't be fooled by labels. Sometimes when you look at companies, they're given arbitrary labels like realestate.com.au is a technology company, right? It's fair to say it's a tech business. They write lines of computer code and they built a website that is turned into a platform and an app and all that sort of stuff. Now, as it's grown, you can probably say it's a bit different and whatever, but at the end of the day, it's probably a tech company. If you're looking for technology companies, you probably want to include it. So according to the new sector classifications, there's this new thing called communication services, which, by the way, is where Google finds itself. Yet you probably think of it as a tech company. So I included the other categories here, like healthcare and that, to show you the full list of companies. Jason says, I prefer data. Potato, potato, says Owen. It's data, says Aaron. Peelborough. Yeah, Peelborough or Peelborough. I just still don't know. I'm from Victoria. Is MP1 Tech? It should be. It should be, Ashley. So if I just go MP1, yes, it is. It's down here. It's at number 80 on this list. And I'll get to why. Is SXL on this list? Let's have a quick look. Yes, it is. Paul, you said, which is the highest? What do I do when there's inflation? Okay, I'm going to explain some things really quickly, Paul. So let me get through some of this stuff. And I did say Castle weird. I said Castle? Probably said Castle. Anyway, so I've screened the ASX, like I've scraped the ASX, and I just use Ticker to do this. This is a tool that costs about $20 a month or $30 a month or whatever. You can go and it's got ASX and global shares in there. It just does data, depending on who you ask, but that's basically what it does. Now, so I've only put in a few metrics to pull these technology companies out of the ASX. And you can see here, I've got the size of the company. That's in AUD. Even though that's written in American capitalization. I've got the total revenue of the business, just to give you some context. Then I've got this thing here called return on invested capital, or ROIC, and it says LTM. Anytime you see LTM in finance, guys, LTM, it just means last 12 months. So last 12 months. Then I've got the revenue growth rate. That's, again, another finance thing. We say CAGR or CAGR. What this stands for is compound annual growth rate. Now, I know we're getting a bit boring here, so I'm not going to dwell on it too long, but I just wanted to introduce you to that just in case you get the spreadsheet after this and you think I'm going to have a play around with this thing and see what it does. Now, I've only looked at a couple of things. So this list here is not a list of companies you should go out and buy. And let me explain why. So when you look at this list, it's worth noting that we want companies with high ROIC. This is the thing, and I think, where is it? Investopedia has the best illustrations that I've seen. They've updated it recently. So ROIC, or return on invested capital, is a way of figuring out when a company has money inside of itself, how good is it at growing that money? So not the money that you get as an investor, but the value of the company. So if you think about if you invest in, say, Telstra, and Telstra has $1,000, it could purchase ads and try and get more mobile subscribers. It could, maybe not with $1,000, maybe it could open a store or employ a new person. All of those are decisions that are made by a company, and they all have an impact on the future profits of a business. And that's what we call return on invested capital. So if it's a high number, it means they're getting a high return on those investments that they're making. Another way to think about this is just imagine I slid a tissue box across the table and I put some money in it. I put $50 in it. And then at the end of the year, we broke open the tissue box and saw that there was $55 in there. that would mean that there's a return on capital of 10% or $5 because we put 50 in and now there's 55. Now, if we left that inside the business again and again and again and again and again, and we cracked the tissue box open after 10 years, there might be $150 in there, which would mean it has a really high positive return on capital. But you as a shareholder, you don't know that. You just know that what's in it is worth more. So the only thing that we get from it is dividends. Remember, that's a different calculation. So I just wanted to illustrate that. We're trying to find something that allows the value of a business to go up. And the metric we use for that is return on invested capital. And you can see it all over on the side here. So you can't just get a list like this. You can't get a list like this and go, okay, bang, Owen's given me 100. I think there's 102 in this list, 102. Owen's given me 102 tech stocks. I'll just go buy them all. Doesn't work like that. And let me explain why. So if we come down here, you can see I've crunched some of these numbers for you. So ROI includes debt. Yes, Anthony, it does. So TTM stands for trailing, same as LTM, which is last 12 months. Wall Street cred revoked. Okay. WO Street cred, sorry, revoked. Okay, so quickly, I crunched the numbers here and I said, okay, this is our list. So we've got this here, our list. So I said, okay, if we just took our 102 companies and we got the average revenue growth, what would the average be of all of these companies in this list? Well, the average would be 24%. That's pretty good annual revenue growth from 2017 to 2022. Pretty good time to be investing, to be honest, and pretty good time for companies to be growing. But the return on capital from those businesses is negative 17% or thereabouts. So the average of this column right here is actually negative 17% because it's weighed down by some serious losers, like these businesses I've never even heard of down the bottom here. Okay. Now, if we just took the ASX average as a whole, so the entire market, I've actually just said the entire market over $100 million. So there's none of that crap stuff down the bottom. So the entire market has grown its sales on average 18%, again, influenced by some outliers. The average return on capital is negative 0.8%, meaning that this is just for the last 12 months. Companies had invested and they've invested poorly on average. If we just look at the technology sector, so just the information technology companies, you can see that have grown around the same rate, but their return on capital is lower. I'm gonna loop this all together in just a second, so bear with me. Now, if we just look at healthcare companies, they have grown seriously fast. So here we can see that healthcare companies have grown the fastest of any of these sectors right here. But again, they've got really low return on equity in the past year, return on invested capital. Energy companies haven't grown as fast as our list, but they've still grown positively over the past 5 years. But they've got a very high return on invested capital, meaning that the money that they're generating is very strong and very positive. Now, I did one more tweak to this list. Instead of looking at companies that are only over $100 million, so that could be some really small companies, I said, well, most people aren't investing in really small companies. So let's just look at the bigger companies, the companies over 300 million US or around about 500 million Australian. If we just look at those companies that are over 300 million, now the list becomes a bit more interesting. We can see that the returns are more positive. We can see energy companies. So this would be like any company involved in energy. So I think maybe AGL is in here. Maybe that's in utilities, but it might be like Origin. It might be like coal companies. All of those companies would be in here. Extremely positive over the past few years, extremely positive because we've seen high coal prices, natural gas, you name it, it's gone up. Now, our list hasn't been as positive. All right. So this isn't speaking very highly to the list as a whole of what I'm about to show you. So it's saying basically, hey, Owen, you know that stuff that you just said, it's actually not that positive. Now, you can see the other numbers here play out. But what this shows me is that the energy sector has boosted the returns of the entire market over the last few years. So if we go back to our category, we can see here that energy is actually a pretty strong and compelling sector to invest in. The problem, well, it's not a problem, but the thing that you have in this sector in particular is it's very, very cyclical. So one time energy prices are up, other time prices are down. You could make the case that companies like BHP and Rio Tinto and large materials and energy companies, um, you could make the case that a few of them make monster profits, and they do. Like you've got like Woodside Group or Woodside Petroleum. These types of companies do very well. But coming back to our document for a minute, if we look through some of the ASX's best performers over the past few years, and we know that the global technology shares are very impressive. We know that many of them are the best performing companies. So even though this data is saying at the moment it doesn't look too positive, Owen, it's actually worth digging deeper into these sectors in particular, because we know that healthcare is a really important industry and it's growing fast. We know that technology is a growing industry and it's growing fast. And now I'm going to throw some curveballs at you in terms of accounting. So one of the reasons why when people do this list, they get put off technology companies is because they look at these figures and they think that that's really negative. How could it be so negative? And why is that impressive? And it's because some of the technology companies are not yet profitable. So that metric actually looks negative. In fact, many technology companies over the past 5 years, as you'll know, have not been reporting profits because they've been reinvesting for growth. Um, and Jason, you've said, since when have energy prices gone down? Yeah, good point. More that they're just cyclical in nature, and that can produce interesting results. And so at the end of the day, many companies within this will be incredibly positive, even though they have negative figures in this column here. So I don't actually know if it's in here. Okay, so say, for example, Xero. The genesis, actually, I'll just bring up my screen for a minute. The genesis of tonight's show came because I was watching investment news yesterday on Ausbiz while I was doing some painting, of all things. I was just listening to Ausbiz in the background because it's a continuous investing news channel. And some of our friends of the show were on there, like Anir Barnes, Scott Phillips. Who else was on there who has been on this show? I think quite a few. I can't remember the names off the top of my head. But Beta Shares were on there. Heaps of investors that you will know from Selfwealth Live were on Ausbiz yesterday. But I heard a comment come through that, and it was actually from Scott Phillips. And he said there are like a few companies on the ASX that are at the absolute top of his list in terms of quality. And he said Xero and Technology One. And that got me really interested because then I thought, well, what do I think are the best companies on the ASX in terms of technology? So Danielle was on there as well. Yes, that's right, Rob. She was indeed. So many were on the show yesterday and who have appeared on Selfwealth Live, which is fantastic. And so I'm going to turn the question over to you really quickly before I get into my list and explain all of that stuff that I just said and why it may not necessarily apply to these companies. Which companies do you think are the highest quality on the ASX? And the reason that I bring that up is because I'm just going to look at the poll, and Cochlear is still in the lead. It's 100 votes too, so that's pretty convincing for Cochlear. So which companies do you think are the highest quality? And when you think of quality, remember we're talking about a business. We're thinking about not the stock price. We're thinking about the business overall. What makes it great? If it's a good product, customer service. Bunnings might be an example that some people go to. And the reason that this is important is because I have this belief that in the future, 80 to 90% of people's money will be in low-cost ETFs or index funds, and only about 10 to 20% of most people's portfolios will be in these types of things, like the individual stocks. And so the way I interpret that is, if you are going to invest in individual stocks, don't waste your time with mediocre companies. It's not worth it. Go and buy the very best companies you can possibly buy and hold them for the longest period of time you possibly can. By the way, another company that Scott mentioned, and not to take the words out of Scott's mouth, but he said that one of the companies that he knows is a company and is held for a very long time. I have a lot of respect for Scott as an investor, obviously, is Corporate Travel Management. This business he's held, I think he said, for something like 10 years. So Chef Circle, you've said Sol Pattinson. I would agree. I think Sol Pattinson is one of the 10 best quality companies on the ASX. Mike said the same. Uh, Easily my top 10 on the ASX, hence why we did a whole session about it a couple of weeks ago. There are other businesses that would feature in here. So I think Wesfarmers is one of these businesses that would feature in my top 10 overall, not just in technology. Jason, you've said CTD is great business. Good to know that you think the same. And there are many other businesses that would fit into this bracket of like the greatest companies on the ASX. But in terms of technology businesses, they're not all built equal. And we don't have this huge amount of depth that we see overseas. Some people would say Ramsay Healthcare is one of the best companies Australia has ever produced because of this. And I know we bang on. On this show how terrible like the share registries are. Those things that you get the letter from when you buy shares in them. But Computershare is one of the best performing ASX companies of all time. Its chart doesn't do it justice, but it actually is if you include the reinvested dividends along the way. So it's a really boring business, but it's done an incredible job of doing what it's done. Wally is another one. You're saying, Jason. And so Chef Circle says Sol Pattinson, but is it overpriced? We can look at that in a few minutes if you'd like. Anyway, so in terms of technology businesses, I'll tell you some of my favorite businesses. And this does not necessarily mean go out and buy them. It actually means go and do further research. You will remember from our discussion not too long ago, this one right here, it was probably a few months ago. So Owen, if you're still watching, you might not have seen this one, but it was from a few months ago. This was one of the things that I was happiest with on the Selfwealth series so far. Let's wait for all my slides to load. I think it was here. Yes, this one. So in this one, we talked about how to build an investment process. So this was going back a little while. And it talks about how even if you have this investment process, all of the companies that could go into it, you still need to put it through you still need to get all of the 2,000 companies that are on the ASX or 10,000 overseas and put them through some type of filtering process to get a watch list. And then you go and do your research, and then you put them on your watch list and go get ready to buy them. And so a lot of people, a lot of people jump straight to, well, it goes through this 2-second thing and then I'll buy it. Like a lot of people will just come up with this list and buy it, but that's not good enough. You need to understand why. Is it everything said here is financial advice? Nothing here is financial advice. And the view that I have, good one, Rob. So the reason that I say go out and buy the best things, right, is because, and the reason why I'm so passionate about this is because only around, and studies back this up, only around about 4% of companies on the stock market create all of the value. So you may remember, and I've got slides going back, I don't know where it was, but I've got slides going back for forever ago that explain that not even 4% of the companies do all of the heavy lifting on the stock market. So even if, you could find one of them, if you then tried to buy it and sell it and buy it and sell it, it's not really going to work out, because then how are you going to find the next one? How long will that take? And so that's why, even though I might be a bit like starry-eyed with my view that if you have this kind of mantra of, well, if you're going to put stuff in these spots, make it good. Like Warren Buffett calls it a fat pitch, as in from like baseball, the analogy being that you wait for the pitcher to throw you a dodgy ball and then you can smack it out of the field. Sometimes Warren Buffett can go many years without making a really big investment. And so I treat every slither of my portfolio as like precious shelf space. Only the best things go on there. Now, when it comes to ETFs, I'm more than happy just to keep buying every month, rain, hail, or shine. But when it comes to individual companies, I can be incredibly slow. So, for example, one of my favorite companies on this list, which is definitely my top 5, and I can't remember who said it, but it's Pro Medicus. I think it's probably, if you just take the past 10 years, it's probably the highest quality company Australia has produced, at least like on the stock exchange. I don't know outside of that. And so PEXA is a great example, Pete, and that would also probably be on my list. I don't know if it's on this list though. I haven't seen it in here. No. So it's not in this list. It's a really good one. Really good point, Pete. So why doesn't PEXA feature on this list? PEXA being this business, which is probably Australia's most, I guess, entrenched software company, yet it doesn't fall into my list here. And the reason probably is, Pete, is because it didn't go through the filter correctly. When I did the list of companies, for some reason, it didn't match up with some of this criteria. So who knows what that is, but I would have missed that if I just relied on this list. Okay, so Pro Medicus is definitely one of them, because as you can see here, it's got the second highest return on capital, but it's done that for, not this exact number, but it's done something like that for 5 years, maybe longer. So it's grown and been profitable the whole time, and it keeps growing. Yeah, so PEXA market cap 2.3 billion, yeah. And yeah, it's still not on my list, Jason. So even in, I can't find it on this list at all, which it should be. PEXA should be here. So Pro Medicus is one. Another business that is definitely on my list is Xero. Now, this is the point that I wanted to tell you guys tonight, is that I own Xero and I own Pro Medicus, and I've held them for years. I think my current batch of Pro Medicus shares I've held since 2017. And through that time, if I had $1 for every time there was some really smart sounding negative piece of news of reasons why I should sell it, like I'd probably have more money in from that every dollar than I would in my Pro Medicus investment. And the same with Xero. How many times have I listened to a podcast or read an article in the news or heard or look at like QuickBooks or Intuit's results and thought, wow, Xero is really losing, and look at how well it's done. Now, I believe that these are the two highest, among the two highest quality companies on the ASX. Maybe it's a bit steep to say the highest quality, but I definitely think they're two of the high quality businesses on the ASX. Now, if you look at the numbers, you would be saying, how, Owen, can you compare Pro Medicus, who has done this and has a super impressive return on capital, like an investment money really well, with this company that only has 4%? And this is where the accounting sometimes gets wrong. So Xero, as we know, is investing incredibly aggressively for growth. So if I just bring this up really quick, is market index really quickly. So if I where are my announcements? Here we go. So if we look at this one right here, I think it is, and we go down, they've got a new CEO, which is great news. So if we go down, we can see revenue incredibly positive. Like it's growing its revenue very fast. It's got a huge subscriber base, but that's also growing very, very fast. But the thing is, it's not truly profitable. So if you looked at the accounting statements, it's actually not profitable like, say, Telstra is. But if you were to put Telstra and Xero side by side and say you can only hold one for 5 years, I would definitely take Xero, because again, if I wanted just a dividend income, some type of thing, I'd probably just go for an ETF and I'd put that in my portfolio. But if I actually want to take a risk on something that might grow over 5 years, this is this thing that I'd put my money in. And I'm not saying like right now, this is just my thinking generally, guys. Because if it's only a small part of my portfolio, like 1 or 2%, I've got ETFs for the other stuff. This is the type of thing where I want to back myself and give myself an exposure. And so we can see here that when it comes down to it, Xero is actually a loss-making business even till this day. So Pete, you've said, hasn't the new CEO of Xero changed strategy towards returns rather than total focus on growth? Exactly. Jenny, you've said, I wish Xero paid a dividend. Yeah, me too. Well, actually, I say that no. For me, Jenny, I'm actually happy to wait. And the reason why, I'll show you why I'm happy to wait. So see this right here, Jenny, this is their calculation, so it's not mine. So here we can see that they have to spend money to make money. See this little bit of blue? What that actually shows you is that shows you that they have to spend around $551 to capture a customer on average. So it's advertising, it's going and doing a road show, it's whatever. But if they're right about their software, they believe that they can capture this much value. So if you go back to my chart earlier on, here, if you go back to my chart earlier on, it's this chart, just the other way around. So, and back to, where was I? Here. That they say, well, we'll spend $550 every day of the week because we believe we can keep customers on average for 9 years and we will recoup $3,500. So they said their argument would be, we don't pay a dividend because we spend that $550 in acquiring a new customer who will bring us more money in the future. And this assumption is based on them keeping that customer. And so far they've done that. I've been a Xero customer for many years. And so that's the dynamic that's at play here. Whereas say someone like Telstra, even if Telstra had an extra $550, it's probably not going to be able to spend as much. The problem with this relationship right here, Jenny, is that if they are investing so much of their money right here, they're spending to the point of losses every year. So they spend so much money on growth that they're losing money. So as Pete rightly pointed out, the new CEO has a focus on profitable growth. That's the key difference, is like profitable growth. So rather than just spend, no, we're actually going to cut back on a few things and we're going to grow in what she believes is a sustainable way. And you can see that here in this chart. So she said she's going to, what was it? She said this when I read, being more focused, being more dynamic, being more measured, being more balanced. Now, this rule of 40 thing is basically a blend of growth and profits. So you can see this playing out here. They've said, we are going to keep spending on sales and marketing, but we expect it to go down over time as a percentage of revenue. And so that's the thing. Oh, Jenny, you've held Xero for 15 years. Well, Jenny, awesome. You've held it longer than I have, so wonderful. Okay, so Caroline, you've said, what's your view on using thematic ETFs in the satellite position? I keep my core diversified and lower risk with satellite for my thematics individual stocks. That's what I do too, Caroline. So obviously I can't tell you what's right for you, but that's what I do too. Is it this one? That's what I do too. So I just keep my core boring and diversified, and I keep the satellites for thematic ETFs, more like exotic investments, and for individual stocks that are more growth focused. There is an exception that I would put managed funds in here. So I would, in fact, I do this, and I recommend this for some people, is putting things like managed funds, so like actively managed funds, but also things like individual stocks, like Sol Pattinson is an example of something that could go in there because it kind of fits the overall theme of what I'm going for. Anyway, back to this list. There are many fantastic companies in this list, but if I just single out a couple more, because I wanted to get to 5, there are many businesses that are we already know that they're fantastic businesses. So companies like Seek, I just saw on my list. Companies like Seek, we already know are fantastic businesses. It's in its next phase of growth with a new venture capital fund as part of its business, where it's investing in other businesses. We know that car sales is a great business and expanding into the United States, another really good business. We know that REA Group, which is up here, we know it's a fantastic business. So these 3 platform businesses, you've got REA, which does property, you've got Seek, which does HR, and you've got car sales, which does automotive. Fantastic businesses. We also know that Cochlear is a fantastic business. Now, WiseTech didn't make my top 5 list. That would be devastating to, I can't remember who said they've held it for many years, but it probably could be. To be honest, WiseTech meets all of the criteria, and I'll go through that in just a minute of what I look for. But another business that is on my top 5 list is Altium. So Altium, we've spoken about a lot. It does software for engineers and designers. So if you want to design a piece of equipment, you would use Altium Designer or Altium 365. So I'll just bring this up really quick if my internet loads. There we go. So if you want software that designs the components that go inside your car or inside your iPhone, inside your vacuum, you use Altium software to design it. And you can see the pricing right there, how clear that is. This is the core software right here. This has been transitioning to the cloud. It's still a great business. It's been through some turbulent times recently, but I still really like the business. And I'll explain why I like these businesses in just a minute. And the other businesses which I wanted, I'll just get it up on my list here. Duh, 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 duh. So the other business which is coming in fifth here on this list is Technology One. Now, Technology One is a bit of an interesting business because I think it's a phenomenal company. And what does it do? It does software for like councils and schools and these types of things. So its customers are brilliant. They're really high quality customers. And on average, so if we were to go back to this chart, we all know what Xero does, right, guys? Xero sells software via accountants to small businesses and medium businesses. Now, this piece of mathematics here is comparing the value of a customer for Xero versus the customer acquisition cost. So this is like saying, how much do we have to pay to get a customer in the door, and how much do they give us over their lifetime with us on average? Not until they die, but until they leave us on average. So if you were to do this same calculation for Technology One, which sells software to schools and to councils and all that in Australia and the UK, what you would is that this chart goes not until year 9, it goes out until about year 90. Because based on their modeling, what Technology One does is they have churn of less, I think it's less, it's around about 1%. So that means they lose about 1% of their revenue that they had the year before from customers leaving. That's extremely low. Imagine if you had a cafe and the customers that you had a year ago, like out of 100 customers you had a year ago, you still had 99 of them today. You only need to find one more to replace that one that left, and you're already at where you're already at like level break even. So more growth just means more value accumulating over time. It's what we call stickiness. So imagine, those things that the flies stick to that you hang, some people used to hang from their ceilings, like the sticky things, a fly lands on it and can't get off. That's what it's doing. It's just going around finding customers. And that's what Technology One does, and what it does so well. So there's another commonality with all these companies, which I'll get to in just a sec. Here we go. Have a sip of my drink. So this is a business, once again, that is moving all of its customers into the cloud so that it can do everything that it already does for its customers, but in the cloud, so that it can increase prices over time. And it's following very much in the footsteps of other businesses that have done this, like SAP and big ERP systems from the United States. And my final company, so just to confirm, we've got Pro Medicus, Technology One, Altium, and we had Xero. And the other company that's on my list is, I don't know if it's actually in this list. Here it is. Number 7, Objective Corporation. So Objective Corporation is a business that does software, but it does it, again, for councils and all these types of businesses. But it does all of the digital things that you could want. So like file storage, file sharing, think of it like Google Drive, but for big business. And it integrates with so many different things. And you can see here who it's used by: builders, regulatory bodies. It's used by any business that needs like content and control what content gets shown and who receives what and so on and so forth. So it's like a massive content management system. This is a brilliant business that has grown for many, many years under this founder, Tony Walls. Now, I'll be really quick because I'm just conscious of time here. I would have all of these businesses on my watch list. I think some of them are more expensive, like Technology One. So I'd be waiting for the market to show signs of weakness, and then I might be, as I do more research, get more conviction in them. But the one thing that all of these businesses have in common, and I'll get to your question in a minute, the one thing that all of these businesses have in common, the 5 businesses that I've outlined, is that they're all run by people that are either founders or like what I call proxy founders. So people that just eat, sleep, and breathe the company's long-term prospects. So some of these other businesses are great businesses, but they've got too big, or they've transitioned into an environment where there's not that urgency and that life or death attitude that comes with being like a founder-run business. but these businesses definitely have it. And you could say the same about WiseTech with Richard White, the founder of the business, who still owns a few $1 billion worth of shares. But all of them, let's quickly go through them. So Technology One, the founder is no longer the CEO, but on the board of directors, I believe. Pro Medicus, we've got Sam Huppert, who probably needs no introduction. Objective Corp, we've got Tony Walls. Altium, we've got Aram. He's not the founder, but he's basically the founder, because the way he thinks, he was at the company, then left and came back. He basically acts like a founder. We've got WiseTech, which is Richard White. Where was my other one? And Xero, obviously, we don't have the founder at the helm anymore, although Rod Drury is still in the background lurking. But this is probably the one weakness of Xero being the last few years. Okay, so some questions. I've got time. So how about NextDC? So NextDC is a business that does, the best way to think about NextDC is the property owner of the internet. So they own data centers, they build data centers, and so on and so forth. I won't click on the sponsored ad, I'll just click on that normal one. So this is not necessarily, I think it's really important for people to understand, this is not necessarily a competitor to Microsoft and Amazon and that. They basically build the infrastructure that all of these companies can put their data centers inside of. Like Amazon and that will do their own occasionally, but these businesses can sit inside these gigantic buildings that have server farms inside of them. So that's one thing. And it's a really interesting business. I don't really like it that much because I just prefer the businesses that are less capital intensive, that need as much money flying into them to fund their growth. But I think it's a good business. And I think, like, who am I to speak about, Bevan Slattery and the team's success? It's obviously very well put together. Anthony, is Dicker Data on the list? That's a great question. Spoke to David Dicker last week. DDR, Dicker Data is on the list. So this is another business that this business, and David has this wonderful. I saw an interview of David Dicker a couple of weeks ago. So this is David Dicker right here. One of the world's biggest collectors of Ferraris. I think he's got the 5th biggest collection of Ferraris in the world. And he started this business many years ago and still runs it. And he was asked a question on I think it was live television, or it could have just been regular television. And the question was, David, can you explain what we do? And he said something to the effect of, we do ICT distribution. And that was the end of the answer. So he basically said, we do IT, like laptops, computers, phones, all this sort of stuff. We distribute products. And that was the answer. And I just loved how succinct it was. And it was just like, no frills. Here's the answer to your question. See you later. And this is a business that just distributes products throughout Australia. But what's really interesting is Dicker Data pays out 100% of its profit as dividends. So 100% of the profit is dividends, which is really interesting because there's not many businesses that do that and can do it sustainably. So that's a really good one. What do we think of ANN? Ansell, I think it's a brilliant business. Just quickly, Jason. I think it's a really impressive business. I don't own it, but I think it's one of those businesses that should be able to just consistently increase prices over time. I'll just bring it up here. Ansell, 1N, Owen. Why isn't the website ranking? That's not good. Okay, it's because I didn't search correctly. No. Okay, anyway. So if you've ever gone into a hospital, you will have seen this company's products anywhere and everywhere right around you. They do gloves. They used to make condoms, but they make gloves. They make protective equipment. During COVID, obviously, the business was a fantastic performer because everyone needed the safety equipment, including in and out of hospitals. So one of those businesses that should be able to slowly increase its profitability through time. They got hit during COVID because of the things like not lockdowns, but because of supply chain disruptions and things like that. But a really, really interesting business. So I will now turn off my screen Now, Angel, you've said, still learning how to find a growth stock that doesn't pay dividends that gives me compounded yield more than 5%, especially if we plan to hold them long term. If we don't sell, we don't realize gains. It's interesting that you say that, Angels, because there's a study that I referenced, and apologies if you've seen this already, but there's a study that I referenced last year that basically shows that of the of all the companies on the in the world, we know that only around about 1 to 4% of them do all of the heavy lifting over time. This is over a very long period of time. Now, if we just take the top 10% of companies, so just the top 10%, amongst that 10% of performers, Boston Consulting Group did a study which showed that over 10 years, the number one thing to look for at those companies is growth. And by that, I mean revenue growth, not growth for 1, 2, or 3 years, not growth for 1, 2, 3, 4, or 5 years, but growth over 10 years. Because over 10 years, you need to be consistent and you need to get that benefit of the 5 to 10-year window of compounding. So a lot of companies come to the stock market and they'll grow for 1, 2, or 3 years, and they'll grow really fast, and then they'll just disappear. I can think of a lot of companies, and I won't name them, but I can think of a lot of companies that fit that bill, and then they just disappear, because what they do is they come to the stock market and they try to grow really quickly by buying other companies or coming with a really crap idea, and they ride a little trend, and then all of a sudden their businesses aren't that good. Whereas you look at companies like Xero, Technology One, Altium, realestate.com or REA Group, Seek, all of these businesses have been around for a very long time. So what you've got to try to do within that to find those top performers, I believe, this is just my opinion, is as investors, we have to find not only companies that have a really good product or service, but also companies that operate in industries that are growing. So industries that can provide a tailwind of support for those businesses over the long term. Now, when it comes down to yield and the role that receiving dividends plays, at the end of the day, and this is a behavioral quirk of human beings as investors, is that we can always just sell some of our portfolio. It doesn't feel right when a share goes up to then sell 5% of the investment instead of dividends. But that's something that a lot of people can do, and they just don't really think about that. I tend to buy to hold. Some people have much shorter time frames, and some people prefer not to sell some of their shares, and they instead get their income another way, whether it's through bonds or cash or something like that. So I could keep going on and on and on. Chef Circle, you said, did you see the horror AFR article on Harvey Norman yesterday? I did not, Chef Circle, but I'm going to go and read it after this because you've said that. So I will go and have a look at that. But that is all we've got time for tonight, except for one final thing, which is this. It's a quote that I want to leave you with, because I thought coming into tonight, we're going to get really in the weeds. We're going to talk about spreadsheets, and we're going to talk about technology. We might even talk about accounting and all this stuff. The last few weeks, we've just been speaking about ETFs and building that core portfolio. Washington hates old Pattinson and keeping it really simple and long-term focus. And tonight, we're getting really in the weeds, which some of us love, like you and me. But Charlie Munger, Warren Buffett's investing partner, is often asked the question, why, if what you do is so good, why don't other people just do what you do? And he says, the reason our ideas haven't spread faster is they're too simple. And if you think about it, if you just try and find great companies with great products, know you're going to lose money occasionally, and you just be really sensible and you read and study these businesses and the industry and the competitors and all this sort of stuff, what you'll find is that doesn't sell books. It doesn't if you went into a financial advice business and they said, oh yeah, just go and buy Vanguard, you'll be right. You're not going to pay them. If you go and see an investment professional and they're like, oh yeah, well, we just buy really cheap stocks and we maybe make 1 or 2 investments a year. You're probably not going to pay the money for that insight, but that's the truth. And so a lot of investors don't copy what Charlie and Warren do because the ideas are too simple. There's an industry built around the outside of making things unnecessarily complex. Sometimes complexity is important, like in financial planning, but for the most part, simple ideas matter. Like if you were to say in the year 2000, well, this Apple Mac is better than a Microsoft PC, and that's all that was your insight. That probably was a better insight than trying to figure out the dividend yield of Apple in that year. So that's probably what the insight that I wanted to leave you with. Even if you get bamboozled by all these things and all these terms and technology companies, just bring it back to, I believe that any investment, any good investment can be summarized with 2 or 3 dot points. Honestly, I'll give you an example. Pro Medicus is run by its 2 founders who are brilliant at what they do. They've won some of the biggest customers in the world, like the Mayo Clinic. They're profitable, and they always have been. Those are the 3 things. Now, if those 3 things don't hold up to be true, if Sam or Anthony, the 2 founders, leave, that's a big signal for me to probably leave. If they stop winning the big customers, that's a reason for me to probably leave. If for whatever reason they stop being profitable, it's probably a reason for me to leave. So those are the 2 or 3 things, and that's why I own shares. And when those break, I'll probably break as well. So I'll probably leave. And you could say the same about many different companies, but obviously it takes time to get that knowledge and to learn those things and what matters and what doesn't. Anyway, I've rambled for long enough tonight. Thank you so much for joining us. We do have 2 big series coming up on Selfwealth Live in June. We will be joined by the team at Intelligent Investor. So I'm talking about Gaurav Sodhi and many others from the Intelligent Investor team. So we are going to go deep into value investing as we close out the financial year. So we'll be talking about everything value investing in June. And I don't know if I can or can't say this, but I'll say it anyway. We will have in the new financial year, we'll have one of the biggest ETF providers join the show for a month. So we've got some big things coming down the pike, some big shows coming up. So tell your friends. Rob and the team at Selfwealth have done an excellent job. You'll find me at Rask. If you want to find out more about what we do, you can head to rask.com.au. Thank you for a wonderful evening. I will be out for tonight. I'm going to dinner to show some people my hand paint, and I will see you next week. And Rob behind the keyboard, thanks for helping us out tonight, guys. We'll see you next week, next Wednesday, 6 p.m.